Hey, good afternoon, everyone. Thank you for joining us on this webinar this afternoon as we're going to be joined with Nationwide here going over their Care Matters product line. But before we get kicked off and started, there's a few things that I would like to go over with everyone about IAMS services that we offer our agents, our back-end support, creative design, and some producer bonuses. My name is Paul Williams. I am a life sales director over here with them. And yeah, let's go ahead and get started with this. So the first thing that I'd like to go over with everybody is our new producer bonus. Is a great way to get kicked off here with IAMS. So our new producers that are joining us within the first 180 days of contracting with us, that we offer incentives to help really build your business, as we do value a true partnership with everyone. And as you can see on the screen, if you sell $100,000 worth of FIA business or $10,000 in target premium on the life side, what you would qualify for. And, as you produce more, your qualifications, become better, even up to the point where we'll build out a website for you, help you create content there. But once again, great way to get started here with us to really help kick your business off. And another way that we like to become a true partnership here with IAMS is our business builders. And as you can see, we do have a referral bonus. So any agents that you're working with, that you have relationships with, that you feel would be a good fit and, get the same value that we are giving you. When you do refer them over, we give a one-time $50 bonus, just, hey, here's a thank you. But where the real value comes in on this is you get a continuous override on the business that they are writing. This does not affect that producer's commissions whatsoever. They are paid out quarterly, and it's just another way we say thank you for this. And it's a really fantastic opportunity to create some passive income as well. And also, as you can see, we do have our marketing reimbursement that will pay $100 for every $100,000 of premium indexed annuity, of course, and $200 into that account for every $100,000 of single premium, and $200 into that account for every $10,000 of target premium on the life side. And this is just another way we like to become that true partnership. This goes into a separate account that you can use for your marketing any way you would like to. We do suggest that you use some of our marketing programs here with IAMS, as we do get some price breaks there. It could be really beneficial to you and helping those dollars go as far as possible. And as I mentioned in the beginning, our back office support works extremely hard for our producers to get business in the door and paid as quick as possible. I know on the live side, we do touch cases every 72 hours. We send out follow-ups. They'll schedule paramed exams for you. They'll help scrub applications, and constantly in touch with the carriers and getting those requirements out to you as quick as possible to keep business moving. And just another resource that we have here at IAMS is our website. It's extremely valuable, where you can go out there and get on Annuity Rate Watch, check out that stuff. You can run term quotes and GUL quotes. We have a final expense quoter out there. Our sales resource library is a huge advantage to all of our producers, whether you need fact finders, presentations, retirement analyzer is out there as well. Once again, fantastic resource. And on our IAMS website, we do have our EAP solutions. So we have Firelight. A new one to us is Luma, iPipeline for your life business. And there are some carriers that do run their stuff through Firelight as well. It's easy to use. It's one-time sign-on. So once you do it, you can just continuously go back, click on it, and you're ready to go. And another thing I'd like to point out here is our creative services. We have a fantastic team that will help you out. You know, if you need a logo built out, if you need color schemes, a website, brochures for you with all your information on there, that is something that we can definitely help out with. And another thing about our creative team, building out these websites, I mean, they work in this area on a daily basis to where, you know, if you have somebody in your hometown that's going to build out this website for you, not saying they don't do a fantastic job, but the content that they may be putting out there and the design and layout may not be as fitting as what it would be having one of our creative teams help you with that. But I mean, if you do want to stick with where you're at, we're happy to come in, take a look at your website, make suggestions for that stuff. And back to our creative team, something that we do here at IAMS, and we do a really fantastic job, is our marketing analysis. So if you're at a place like, well, I know I've tried marketing with these people or these vendors and just things haven't worked out, or you're just looking for a direction to go, we're happy to assist with that. We'll sit down with you. It usually takes about 45 minutes to an hour to get through it, but we really want to understand your goals, where you're at, and to get you to where you want to be. Then once we create our marketing analysis for you, our creative team puts everything together in about a 20-page document of our suggestions. Then we would like to follow up with you about once every 90 days or a quarter to go over everything to see how it's working, if we need to make any tweaks, or if everything's set and good to go, flowing nicely. Let's keep it where we're at and keep business moving. And our IAMS Wealth Management, this is something that's relatively new to IAMS. We've been doing it for about 6 years now, but it has been a great sector of growth for us here. And you know, it's a great way to increase your revenue, improve client retention, and just really help strengthen those relationships. I know the more financial things that we have on the books, the stickier the business becomes, and they really come and look at you for that holistic solution. If you'd like more information on any of the material that I'm talking about, please give me a call, or one of our directors over here. It's 1-800-255-5055. And our life and annuity academies, we actually have one coming up next week, which I believe will be our final one for this year. But it's an amazing opportunity to get with like-minded people, go over through what's kind of going on in the industry, talk shop with some of these guys, and we have great key speakers that come in to go over different sales ideas, advanced marketing, tax planning, building your brand. Great opportunity here. I know everybody that has ever attended one of these has found amazing value in it. Once again, if you'd like to attend one of these, which I believe it will be next year, starting off probably late spring, give me a call. It's 1-800-255-5055. And our trip to Quebec is for our qualifying agent. As you can see, we're going to Quebec. If you need any additional information on this, scan that QR code, give me a ring. You can even shoot something over there into the questions, and I'll be happy to get this information circulated out to you. And as always, like and follow us on Facebook and LinkedIn, as we're constantly posting relevant material that you can use to share with your clients, daily articles, quick posts you can download, things of that nature. But from here, I will turn it over to Sharlene, and she will go through the Nationwide Care Matters products.
Awesome. Thank you, Paul. I appreciate that. And thank you all for joining us here this afternoon. As many of you may know, Nationwide has been in the long-term care space for some time. We actually were the first with a cash indemnity LTC rider back in 1999. And now today we're here to talk about our hybrid solutions that are in the marketplace. So today we'll talk about Care Matters 2, which is our individual solution, and then we'll follow up with the Care Matters Together, which is our joint solution, which just came out last summer. So we're just hitting up on a a year anniversary on that. One of the things that we like to tout about our contracts, and this goes for both of them, is the guarantees. When we think about long-term care planning, most of our clients really want to know that this is guaranteed. I'm going to set this and I'm going to almost forget it, if you will. We hope you don't really forget it, and we'll talk about that in a minute, but you can be guaranteed the long-term care benefits from the start of your contract. You have a guaranteed death benefit. You're guaranteed to get your money back in different options. We'll talk about those. And then we do have the option, if you get into, let's say, a 10 pay and you decide in 5 years, I'm done, I don't want to pay anymore, we can do some paid up benefits for you. So there's a lot of flexibility in our solutions. We'll talk a little bit how it works here, and we're going to show this as a single premium option. But what we did on this one, we have a 55-year-old male, and we wanted to start out with $5,000 a day for that monthly LTC benefit. We do have a 3% inflation on this. So you'll see the 3 different buckets, and many of you are probably familiar with how this looks. Most hybrids will work in the same fashion. So you have the 2-year bucket at the very beginning. That's going to be the acceleration of your death benefit, and that will be the first 2 years. And once that's exhausted, you'll then go into that 4-year bucket of $240,000. That's what we call your extension of benefits riders. Different carriers call it continuation of benefits, different things, but it's all the same. This is really a true long-term care bucket. And then the total you'll see there. If we had this gentleman on claim for 6 years and he went on claim day 1, he would have gotten $360,000, or he'd have options of $360,000 total LTC pool. And in this particular product, we can go out to 7 years, but 6 years seems to be about the average sold on all the individual cases. So we start with that. One of the other things for you to note is where it says here, guaranteed minimum death benefit is $24,000. And what this means is if your client uses every bit of the long-term care, they are guaranteed a 20% residual death benefit. So 20% of that initial specified amount of $120,000 will be paid to your client, even if they've used all $360,000, or if they went to age 80, they have a total payout there of around $812,000. The beneficiaries will still have that $24,000. I know Paul mentioned a little bit that they're in final expense planning. This might be that type of plan for those clients. This helps with those final expenses. When we talk about our solutions, I mentioned the cash indemnity, the long-term care rider. Our Care Matters 2 and Care Matters Together solutions are also that way. So all the benefits are received as a cash indemnity payout. We have no restrictions on what your clients can do with the money once they're on claim. We have 5 different payment options. We'll get into that here in a minute. We have some flexibility with 1035, unless you're selling in the state of New York. That's a different product. I'm sorry for those people, but we can talk offline if you have New York questions. We have the 3 different inflation options, refund of premium, retroactive payment, and then separately identifiable premiums. So in the Care Matters individual contract, you will see these payment options. Single pay 5 years, 10 years. Those are pretty commonplace in the market. Pay to 65 is also another option. And then Nationwide also has a pay to 100 for your clients that are 65 or younger. So this bucket, we start to see more people that will look at traditional long-term care, but then will also come to Paul and say, what does a hybrid look like if I pay to 100, and make those comparisons. So although most of the sales are still in that single 5 and 10 pay arena, we are starting to see a little bit of a pickup in that pay to 100 for those clients. I mentioned the inflation. These are pretty similar, as you'll see in the marketplace, 3% simple compound and then a 5% compound. Return of premium options. So these are a little bit unique, and I'll start with C because that's where we see 95% of the time. That says minimum refund of premium with max LTC. So that means exactly what it says. This option is going to give me the most LTC for my dollars, but I'm going to get the smallest amount of cash if I surrender early. So what you'll see in that one is the illustration will have a cash surrender value that you're used to seeing on your other life illustrations. That will be what they would get if they would surrender it. Flip back to A or B. A is a vested option. That is going to give you the most return of premium. So at year 6, you can get 100% of your money back. And then option B, the one-time step up. We do see this one quite a bit for someone that's like, I'm not really sure I want to go all the way to C and get that max LTC. but I don't want to give up so much in that vested option. This one-time step up allows you 80% of your premium to come back in years 1 through 10, and then at year 11 you could get 100% back. So 3 different options for your client. Again, we find 90 to 95% of our cases are issued in that C bucket, is really truly in the marketplace. If you did a study on the long-term care, I think the last option I heard was 2% or less of the people actually surrender their long-term care, whether it's a hybrid or a traditional. So we don't see a lot of folks surrendering it, but for those that really want that option to do that, we certainly have it built into our contract. Then we have a 90-day elimination period. That again is pretty commonplace in the market, but ours is retroactive. So what does that mean? That means if your client has a $10,000 monthly long-term care benefit, for those first 3 months, 90 days, they will get no payment from Nationwide. But on that 4th month, they will get a check from us, not for $10,000, but for $40,000. So we want to make sure that it's a long-term care claim. That's why we go the 90 days. Also, it helps with the cost of the contract to your client. But on month, that 4th month, they will get that money back. So what you can think about is with Nationwide on a 12-month claim, you do get 12 monthly payments. In that 90 days, let's say you had somebody that had a mild stroke and needed care for, let's call it 12 months. They received care, so they went through their waiting period, they had 12 months of care, and then fast forward 5 years down the road, it happens again. That elimination period only has to be met once. So there is no, there is no waiting period again if they should be unlucky and have that second event. All right, I'm going to pause there, Paul, because that's really the Care Matters individual contract, pretty quick and simple, but any questions on that before we go to the joint product? Okay.
I don't have any questions on it. I haven't seen any questions come through
Awesome.
on my end.
Okay. If there are, you can drop them in the chat box, or we can take them here at the end. Then we'll keep going. So some things are better together. I like how marketing put that together. So this is Care Matters Together. For those of you that have not seen this, it is a joint version of our individual contract, Care Matters 2. And it will work pretty similarly, but you'll hear me with some different language here. So on the Care Matters Individual Life and your other hybrid products that are out there, you're going to hear, we want 2 years, we want 4 years. My example I mentioned was 6 years. On the joint product, you'll hear us talking in monthly payments. So 48, 72, or 96 monthly payments. And we'll talk about that and the why in just a minute. But that is a completely shared pool. So 42 months, one person could use every stitch of it, 72 months, 96 months, or it can be sliced up in many different fashions. And I'll show you a couple examples of how that means. What it's going to look like, and this is busy, so I apologize for that, but there's 2 different options. I'm going to focus here on the left where it says both insureds preferred. This contract, instead of the sample I showed you for Care Matters 2, where there was 24 months, that acceleration in the joint product is 36 months for both insureds being preferred. And then you can see that extension of benefits that you saw before, that was 4 years. Here we have 12, 36, and 60 months, depending on the options. That doesn't change anything for you. You really don't have to know that, but just the 36 months is the acceleration piece. So how would that look like if we had a couple that had the 96 payments and one of them goes on claim? In this example here, we have Monroe, and he's going to go on claim for a full 24 months. He comes off claim. I like to say he's gotten better versus something happened. So Monroe has recovered from his disability and his long-term care claim. And then 2 years later, his wife Dolores needs to go on claim. She actually is on claim for an extended time period, and she gets 72 payments. So you can see here that those 96 monthly payments were paid out in this fashion. They were paid out over a 10-year scheme because we had 2 years off claim. Now, what about a couple that goes on the claim together? So in this situation, we have Stephen and Michael, and Stephen goes on claim, and then in year 2, Michael actually has to go on claim as well. So again, this is a 96 monthly example. They did get 96 payments. They were just paid out in about 6.5 years because there was an overlapping claim. And the last scenario is that we have John and Lori, and John goes on claim and he uses all 96 months. So that is definitely an option for John and Lori when they get to that period of time. After the end of those 96 payments, obviously there are no more long-term care benefits that would be paid to Lori. There is still a residual death benefit on this contract. So once John and Lori both pass, there is a death benefit of 10% of that initial specified amount that would be paid to their beneficiaries. So some product information on Care Matters Together, and this again, when you're running illustrations, Paul will know this, but you'll run up against some minimums. The product itself has a minimum long-term care benefit of $1,500. So that's the minimum monthly benefit that we can issue. So if you're looking at one of the other 3 states here that you bump up against it, and you've asked Paul for $2,500 in South Dakota, and he's telling you, sorry, I can't run it, this is why. But again, you don't have to remember that. Paul will know that. And maximum at issue there is $20,833. I can tell you I've seen 1 or 2 of those in the last 5 years. They do happen, and we are open to take those. You can add inflation to that. We just can't be more than that at the very first monthly payment. The issue ages on this product are 30 to 70. I don't know that I mentioned that on Care Matters 2. Individually, we can go 30 to 75. But you'll see here the various different options. So on a 20 pay, I have to be 65 or younger, as well as the 100 pay, or pay to 100, I have to be 65 or younger. Now that the bottom footnote there says there's a 25-year age difference. What does that mean? That just means if I have two people, let's say husband and wife, they're both preferred, I can actually issue those folks 25 years apart. I don't know that we see that happen very often, but it can happen. If for some reason one of my insureds is standard and one is preferred, the maximum age difference I can have is 10 years. And I'll talk a little bit about that standard rating here in just a second. The premium payment options on this a little bit different than the Care Matters individual, just by the 4th bullet there, the 20 pay. So when I showed you Care Matters 2 individually, we have a pay to 65. We changed that for the joint contract to a 20 pay. And we are finding that to be a very popular offering, I believe, because we're looking at folks 45 to 50. They like that 20 pay option. Now, one thing that's really important to note, and probably one of my favorite features of the Care Matters Together contract, is this last sentence that says the premium will be waived while LTC benefits are being paid. So as long as one person is receiving long-term care benefits, the premiums are waived. That is not true of the individual contract on the iteration it is today. We're hoping to add that in the future. But today on a joint contract, so let's say I had a 20 pay option, and one of my insureds goes on claim at year 15. Those premiums are waived then until that person comes off claim. And that is a built-in option. It's not a rider that you have to choose when you're running the illustrations. So again, the long-term care inflation options, here we changed it a little bit differently. You still have the 3% and 5% compound for life, but what we added here is a 3% compound for 20 years. And this is to be more in line with some of your traditional long-term care. You'll see that out there, as well as we see the joint contracts. A lot of folks in their 60s, early 60s are buying these. So if you look at the average age in claim is 80 to 85, take my 60-year-old or a couple 62-year-olds, that puts the inflation on there until they're 82 years old. So it really gives a nice option to have inflation, but to not continue to pay for it in those later years. And it really does bring down that annual pricing on the policies pretty significantly. So just another option for your clients. The underwriting classes here are a little bit different than what you might be familiar with looking at on a hybrid contract. We have preferred and we have standard, and both tobacco and non-tobacco classes. So today, if you had someone who could qualify for our individual Care Matters 2 product, they would be a preferred risk. And think about that in time of life underwriting, that kind of qualifies for a table D up to preferred. Those people would get an individual contract. If you could not qualify for an individual contract, then you're likely going to fall into that standard category. And that standard category would go from 5 to 8 tables for the risk. So we can have one preferred and one standard, I cannot have two standards because we could not price the product competitively enough at this first iteration to make that worthwhile. So if you have two folks that are highly impaired, likely it won't be an offer. But if I have one preferred, I can get that second one as a standard risk class. What I would tell you here is we have a wonderful pre-screen team, and I know Paul and his group do a great job of the field underwriting and the pre-screen as well. I always ask, just run it by us. We do have a cheat sheet on things that are automatically knocked out. I mean, things that you would obviously know if they're being treated for dementia, Alzheimer's, Parkinson's. If they're, currently undergoing physical therapy, that's a no-go right now. One of the examples I'll show you on preferred versus standard is medication changes. So on an individual policy, we like to see those medications for 12 months being very stable. We don't like to see any changes in that. If we have someone who has had a change in the last 12 months, they can, depending on the medication, they can qualify as a standard risk. So I could get them in a joint policy versus an individual policy. The elimination period again here is exactly the same as I mentioned earlier on that Care Matters individual policy, 90-day retroactive, same example. So we've got that 40,000 coming on the 4th month, and then the remaining of the benefits would go back to the 10,000. And I mentioned previously the 10%. So on the individual policy, we have 20% residual death benefit. Again, if every stitch of long-term care is used up, this is still going to be remaining for those beneficiaries. On the joint policy, it's 10%. We're the only one in the joint marketplace that actually has a residual death benefit. So that's an added bonus for your clients. And then I just want to jump real quickly here on our individual and our joint policy. You'll see a actual supplemental page in the illustration that talks about the LTC premiums. And we all love tax deductions, especially if you work with any business owners, our CPAs, they all really love that. But you'll see in our illustration that we break out the life insurance premium and then the LTC premium. And what that does, that allows your client to talk to their CPA and think and look and see, do I qualify for a deduction for my long-term care piece of this? The life insurance component we know is not tax deductible unless you're a C Corp. That's a whole nother story, right? But reasonable compensation, you can deduct that life insurance premium. It would be taxable to the employee. But take a look at that next time you look at a Care Matters illustration. That's a really nice place for your clients to take a look and use some deductions. We also get asked a ton about, can I use my HSA dollars to pay for long-term care? And the answer to that is yes, you can. They're subject to age-based limits, which the accountants will know, or I can send over to Paul and he can get that to you. But it's definitely an option there. In addition to the tax deductibility, we get asked probably on a weekly basis about international benefits. I use my sister as an example. Her youngest child lives over in England, and they've decided that they want to go over that direction when they retire and live somewhere. Spain, I think, is where they resonated on the last time they were over there. Changes every trip. But if they truly are going to go internationally, they can, in fact, take this policy with them. 100% of those first 2 years that I showed you on the individual, or the first 36 months would be on the joint contract. Those benefits would be payable outside the United States. The extension, that second bucket that I showed you on both examples, would not be payable outside the country. They would have to come back in for those to be paid. I will tell you here, though, there are some ways that we can work around that. Again, in my sister's situation, what I would do is likely sell her a 2-year policy with a 5% inflation. So now I have a really beefed up, short, fat contract, if you will. And all of those in that first 2-year bucket would pay to her. So there's definitely some work that Paul and I can do with you on that if you have someone who truly is going to retire internationally. And then we get asked a lot about using IRA distributions. We know there's a lot of clients out there that have qualified dollars that really truly do not plan on using all of them in retirement for an income source. They're concerned about long-term care. They kind of like to tap into those dollars now and take a look at that. So this slide's busy. I apologize for that. But what basically, in a nutshell, they're going to take that money out of their qualified account. You do want them, of course, to be 59.5 or older so they don't get hit with that 10% penalty. They will transfer that to a qualified SPIA. and then that SPIA can be used to funnel back to the Care Matters or Care Matters Together contract. They do pay taxes as it comes out of the SPIA. Sometimes we get asked that. So yes, I can't magically get you out of your taxes, but it certainly is a great way to leverage those qualified dollars. And lastly, I just like this slide. It's another place to kind of take a look and see where would those dollars come from as you're talking to your clients, and where might they come from early on, 40 to 45, where might they come from if they're retired or somewhere in the middle. So just kind of a nice little cheat sheet to think, oh yeah, wait, I have someone who's selling their business, or I actually had someone in Nebraska say, well, what about I'm renting my land? How about rental property or rental income? Sharlene, you need to put that on here. So just some great ideas for your clients. And briefly, then, I'd just be remiss if I didn't talk a little bit real quickly about Nationwide. Hopefully, many of you are familiar. We are a Fortune 100 company. We've got some really great, strong ratings out there in the marketplace. As you can see, bottom right-hand corner, #1 last year in the ratings for linked benefit in this space. So we're very proud of that. We do try to do our very best for the members that we have in our pockets, and we also keep them in mind as we go forward. So as we change things on the life insurance, let's say, we always go back to where we can and add those same benefits to the existing policyholders. The Care Matters contracts, we have what's called a concierge service, and that is a complimentary service available to Care Matters and the long-term care rider now when your clients do need to go on claim. We added that back to all of our existing policyholders, so everybody has access to that benefit. So one of the things I do love about Nationwide is how they do treat their in-force policies. From a life standpoint, we've never increased our cost of insurance. Again, I think that speaks volume to the partner that you're picking with Nationwide. And with that, I'll turn it back over to Paul, see if anybody has any questions on either of those solutions. Thank you.
Thank you, Sharlene. I really appreciate that. We did have a few questions that came in as you were presenting. So kind of going back to where we were looking at the Care Matters Together, asking what was the max age? I know you touched base on it when we got into the Care Matters product together, but just to kind of go over that again.
Sure. The minimum age is 30 for both products. The max age is 75 on the individual and 70 on the joint.
Perfect. And also, is this product available in Illinois?
It is. Both products.
Okay, fantastic. Another question that came through, it says if client does a 20 pay, can they include the return of premium? Generally, what's the markup for that rider in relation to a base policy premium?
So they can on the individual contract. The joint policy does not have, and thank you for asking that question, I didn't address that. The joint policy does not have the same options. It is just the cash surrender value, but the individual policy, they can add that. It'll vary depending on issue age, and what their long-term care benefit is. I've not seen it to be, not like 30% or anything like that. I would say probably somewhere around 10%, but it varies so much by age. I'd be happy to run a sample quote for anybody.
Fantastic. And another agent asked that if he's understanding this correctly, that if the 20-year compounding inflation is elected, that the inflation premium drops off in the 21st year.
So it's actually just a lower premium from the very beginning of the contract. So you wouldn't see a reduction in that premium. But if you ran a 20 pay for life versus the compound for 20 years, you would see a savings at the very beginning of the contract. Great question.
And also, do you have hard copies of the Care Matters 2 brochures that they can receive?
Absolutely, you bet.
Well, Sharlene, I know when you were presenting and you were going over the retroactive
Mhm.
to where in the fourth month you would receive the 40 instead of just the 10,000. Do you know of any other company that has that feature?
At this point, I do not. I do know there's another company out there that actually has a 0-day elimination period. So they do have that right out of the gate. Once they've been qualified 2 of 6 dependent, they don't have a waiting period. That's the
Hmm.
only other option out there that I know of at this point.
Okay.
Mhm.
And like you had mentioned before, I know age, um, and if it's single or joint, has a lot to do with pricing of this. But just in general, I guess, do you see a price point of where Nationwide looks more competitive than some of the other carriers out there?
Yeah, that's a great question. Currently, I would tell you our cells are likely under age 70. So there's some competitors out there that will beat us in the cells over age 70. That's not our wheelhouse. With that said, I have written a couple that are preferred in their 70s to individual contracts, and it did look really nice, but it will depend on that. But for the most part, we have been pretty strong, 1 or 2 in most of the cells with our current pricing.
Okay.
And on the joint product, I would tell you it'll just depend on that design, because our competitor in that space, has some different ways to design their contract. But for the most part, in that joint space, especially because our policy is a cash indemnity, if you're looking at cash, we're going to be the only player in the joint space that pays out in cash.
Nice. Fantastic.
Hmm.
Well, it looks like the questions just kind of slowed
Hmm.
up here. Is there anything else that you would like to add or just bring up or to be aware of, opportunity-wise with clients?
Yeah, just real quick, we didn't touch on the underwriting and what does the process look like if your clients decide to apply.
Yeah.
And I think that's a pretty neat story for Nationwide. So we can have a whole digital experience for your client. We do not do exams for our care matters or the care matters together. So there's no parameds, no blood ordered, I should say. And we can send a link to your client to digitally complete their Part B. They still have an option if they prefer the telephone. That is always an option, but they can do this digitally. If they're under age 60, that's it. We get that digital Part B back, and that goes to the underwriter, and a decision is made. In 16% or less of the cases do we order an APS, and the only time we order an APS is if we're on the fence of either declining your client or giving you an offer. So we want to make sure that we get everything we can. In California, that's a little different. If you have any clients there that work in California, because we order a lot more APSs in California just because they don't allow us to ask what we call reflex questions. So you'll see a little bit higher APS percentage in California. But for the clients under 60, can do it completely digital. For those over 60 to age 69, we recently launched what we call a digital cognitive. And I know that sounds a little bit strange. You're like, how do you do a cognitive test digitally? We do not have your clients turn on their camera. We're not looking at them. It's literally a 3-minute interview of questions. And that has been very well received in the marketplace. It's very easy to do, and they still have to pay attention. It's a timed test, so we want them to be distraction free. But it's really been great. So 69 and under, if your clients are comfortable with a computer, they can have a complete digital experience from start to finish. So really like that process.
Nice.
Mm-hmm.
All right, let's see. Looks like a few other questions came in.
Mm-hmm.
All right, so in the Care Matters 2, with the 3% inflation, does the inflation increase the first 2-year payments?
It does. Our inflation is from day one. Great question. Mm-hmm. It actually inflates
And
too while they're on claim.
mhm.
It'll continue to inflate. Yep, sorry, I didn't mean to cut you off there, Paul.
Nope, that's all good. And last question. Uh, let's see. Please explain how the inflation affect the payment again.
how the inflation affects you. So our
The
inflation would work.
payments. Mm-hmm.
Yeah, the payments would work. Our inflation starts from the day one. So I know that we have a competitor in the marketplace that you have to buy inflation on the base and then buy it on that extension. Ours is, if you buy inflation, it's going to be on there. So it'll start compounding the day you buy the contract. So let's, if you bought that 3% compound for life, day one, month one of that policy, it'll start inflating. Even when you go on claim, so let's say that client goes on claim at year 20 and they have a lifetime inflation, even when they're on claim, the remaining bucket of long-term care dollars will still continue to inflate.
Nice. And do have an agent asking if they have any more questions. Can they reach out to you directly?
Sure, absolutely.
Fantastic. All right, guys. Well, that's all I have for y'all today. I really appreciate everybody's time this afternoon as we went through these products. Once again, if you have any questions about this, you can contact Sharlene directly, or you can call myself on this, and I'm happy to help as well. 1-800-255-5055, or you can always email me at paul@iamsinc.com.
Thank you, Paul.
Thanks. Yeah, absolutely. Thank you again, Sharlene, and I hope everybody enjoys the rest of their afternoon.